So once you've found your dream home and applied for a mortgage, there are some key things to keep in mind before you close. It's exciting to start thinking about moving in, decorating your new place, but before you make any large purchases, move any money around, or make any big life changes, be sure to consult your lender. Someone who's qualified to explain how those financial decisions might impact your loan. The first thing, don't deposit cash into your bank account before speaking with your bank or your lender. Lenders need to source your money, and cash isn't easily traceable. Before you deposit any amount of cash into your accounts, discuss the proper way to document your transactions with your loan officer. Number 2, don't make any large purchases like a new car or furniture for the house. New debt comes with new monthly obligations. New obligations create new qualifications. People with new debt have higher debt-to-income ratios, and since higher ratios make for riskier loans, qualified buyers may end up no longer qualifying for your mortgage. Number 3, don't co-sign other loans for anyone. When you co-sign, you're obligated. With that obligation comes higher debt-to-income ratios as well. Even if you promise you won't be making one of those payments, your lender will have to count those against you. Number 4, don't change bank accounts. Remember, lenders need to source and track all your assets. That task is much easier when there's consistency among your accounts. Before you transfer any money, speak with your loan officer. Number 5, don't apply for new credit. It doesn't matter whether it's a new credit card or a new car. When you have your credit report run by organizations in the multiple financial channels like your FICO score, it'll be impacted. Lower credit scores can determine your interest rate or even eligibility. Number 6, don't close any credit accounts. Many buyers believe less available credit makes them less risky and more likely to be approved. This isn't true. A major component of your score is the length and depth of your credit history, and your total usage of credit is a percentage of available credit. Closing accounts has a negative impact on both of those determinants for your score. The bottom line is, any blip in income, assets, or credit should be reviewed and executed in a way that ensures your home loan can still be approved. If your job or employment status has changed recently, share that with your lender as well. The best plan is to fully disclose and discuss your intentions with your loan officer before you do anything financial in nature. Don't forget to like and subscribe for more tips.